Welcome to The Explainer. Today, we're tackling the massive question keeping Wall Street awake at night. Are we in an AI bubble? We're going to take our time with this one. Slow down, tune out the frenzy, and just look at what the data is actually telling us. Let's get right into it.
I want you to just look at this number. Really let it sink in. $35 billion. On July 24, 2026, one of the buzziest hedge funds in the entire AI space, a fund named Situational Awareness, lost $35 billion in value. And they lost it in just about 3 weeks. We're not talking a 35% dip. That is $35 billion, literally wiped off the map in less than a month.
But here's the absolute crazy part about that collapse. It didn't happen because AI suddenly stopped working. Not at all. It collapsed because of one specific word. A word that shows up right before literally every single market bubble in history: leverage. It's the true villain of our story today, using borrowed capital to boost your potential returns. It's basically pouring gasoline on the fire of market enthusiasm. Imagine buying a house with a tiny down payment, right? But doing it on a multi-billion-dollar scale.
So that brings us to the central question for this explainer. Is the US stock market actually trapped in an AI bubble? I mean, think about it. Ever since ChatGPT launched in late 2022, AI-related stocks have driven roughly 75% of all S&P 500 returns. 75%. That's one single theme carrying an entire market index on its back. If you're wrong about this market, in either direction, it's going to be an incredibly expensive mistake.
Section 1. The bear case. Is it 1999 again?
Let's kick things off with what is arguably the scariest metric for market historians, the Shiller-Cape ratio. It's a valuation measure that smooths out earnings over a 10-year period. Well, in 2025, that number broke above 40. For context, that is a dangerously extreme valuation level. It's a height we've only seen hit one other time in market history, right before the dot-com crash. And look at how the market is structured. At the absolute peak of the dot-com bubble in 2000, the top 10 companies made up roughly 25% of the index's total value. Fast forward to 2026, and those top 10 companies, they make up around 35%. Today's market is significantly more top-heavy than the last massive tech mania. I mean, Nvidia alone is valued at over $5 trillion. Then we have to look at the actual results. A really widely cited MIT study found that 95% of generative AI projects inside businesses failed to produce a measurable return on investment. 95%. Let's just pause on that for a second. If companies can't turn hundreds of billions of dollars of AI spending into actual profit, well, all those chips and data centers start looking a lot less like an investment and a lot more like a very expensive gamble.
On top of that, the credit markets are starting to whisper their own warnings. The interest rate gap, the spread between risky tech debt and safe government bonds, has been creeping wider. And this is usually the very first place financial stress shows up. When you combine this extreme valuation with a weak ROI, it makes sense why firms like Capital Economics are out there predicting a multi-year unwind of US equities. But hold on, because that's really only half the story.
Section 2. The bull case. The difference is profit.
You see, back in 1999, tech companies were just burning through cash, spending way more than they generated for nearly a decade. It was a bubble running purely on hope. But in 2026, it's a completely different landscape. AI capital expenditure is being funded almost entirely out of actual, real earnings, not debt.
Just look at Nvidia. They brought in close to $216 billion in revenue this fiscal year. That is up 65% from the year before, and they're doing it with profit margins above 50%. This isn't just vaporware or hype. This is literally one of the most profitable large companies on the planet, proving that, hey, the money is very real.
And honestly, the demand side is shockingly healthy right now. We aren't seeing shrinking free cash flow across the sector, we aren't seeing collapsing profit margins, and there is no wave of companies quietly loading up on desperate balance sheet debt just to keep their AI dreams alive. This is exactly why major players like Goldman Sachs and JP Morgan are arguing that sure, the AI trade is expensive right now, but it's definitely not fake. So we've got two perfectly reasonable readings of the exact same market. What happens when the bear and bull realities violently collide?
Section 3. The ultimate stress test, the $35 billion collapse.
Let's track how this actually played out. In 2024, a former OpenAI researcher wrote a really famous essay and then used that fame to launch his own hedge fund. By mid-2026, this fund had swelled to a staggering $45 billion peak, and it was heavily concentrated in AI infrastructure. But then, in July, semiconductor stocks went through a natural correction, dropping by roughly 25%, And by late July, that massive fund was forced to liquidate down to just $10 billion.
Here is where the math gets terrifying, the 400% leverage effect. Look, a 25% drop in ship stocks is painful, sure, but it's totally survivable for most. But this specific fund was reportedly juiced with up to 400% leverage. That is like driving a Ferrari at 150 miles per hour on black ice. When you borrow that much money, your losses compound disastrously. It triggered fatal margin calls that the fund simply could not meet.
And that triggered a violently fast unwind. The fund was essentially forced to sell almost its entire public stock portfolio at a massive discount. Ken Griffin's Citadel actually stepped in to buy the bulk of it. But during that chaotic little window, that forced selling briefly wiped out about $3 trillion in semiconductor and AI market value before buyers finally rushed back in.
Now, you might think the quick bounce back is a good sign, but the fact that stocks recovered almost immediately should actually worry you. Market skeptics like Michael Burry have been warning about this exact phenomenon. Just read this quote. "It teaches leveraged investors the wrong lesson, that dips get bought, no matter what." Wall Street basically decided, hey, this wasn't AI breaking down, it was just one over-leveraged fund blowing up. But treating a massive near miss like that as a buying opportunity, that is exactly how you set up the next, much bigger disaster.
Section 4. The Blueprint. 4 metrics to watch.
So, how are we supposed to navigate all this? Well, here is your blueprint for tracking this yourself. Step 1, CAPEX versus free cash flow. As long as the hyperscalers, those massive cloud tech giants, are funding AI with their own earnings and not debt, we're okay. Step 2, tech debt credit spreads. If the gap between risky tech bonds and safe treasuries starts to widen, the market is pricing in real doubt. Step 3, earnings versus expectations. We really need to see if that massive CAPEX actually turns into revenue or if that scary 95% failure rate holds true. And finally, step 4, systemic leverage. If leverage bets keep growing after a near miss like we saw in July, it is setting us up for a much, much bigger crash. To bring this whole explainer home, let's just synthesize exactly what the data is telling us right now. The underlying AI technology, it is absolutely sound. The profits being generated by companies like Nvidia, they're entirely real. So the structural comparisons to the dot-com bubble don't perfectly hold up. But that fragile, massive layer of borrowed money, the leverage sitting right on top of the technology, that is the true existential danger to this market right now.
Because that is the trade you're actually watching play out, whether you realize it or not. So I want to ask you directly, looking at the massive profits versus the incredible leverage in the system, are you buying this dip, or are you staying safely on the sidelines? Drop a comment below, engage with the data we've laid out, and let us know how you're navigating these risks. Thanks so much for joining me for this explainer. Keep your eyes closely on those metrics and take it slow.